Now that we know about the negative list, input tax calculation and the conditions attached, let's move on to the special circumstances relating to transfer of input tax credit. There are three types of transfers where the government would transfer input tax credit previously not granted to the taxpayer. So that's one transfer from government to taxpayer. Second, one business could transfer input tax credit to another business. And the third is where the taxpayer is paying back credit earlier claimed to the government. He's forfeiting credit claimed. We can actually assign popular terms to each of these situations. The first one, where the government is giving credit which it did not allow earlier, you can call it as something like retrospective relief. The second one is to do with mergers, acquisitions, all of those corporate actions. And the third, well, the taxpayer has to forfeit credit claimed, so it's our normal retrospective taxation. What are the circumstances which give rise to transfer in these three cases? In the first one, where the government would have to give credit for earlier ineligible input tax credit to the taxpayer, there are two reasons. One, relating to registration, and second, where a previously exempt supply is now taxable. The second situation is a very simple and logical one. A business will transfer all its liabilities and assets to another business when there's a change in constitution. There's a sale, merger, demerger, amalgamation, lease, or transfer of the business. Third situation, where the taxpayer would have to forfeit credit earlier claimed to the government. It is opposite of the first situation, where an earlier taxable supply has now become exempt, or the taxpayer has chosen for the composition scheme, or he's disposed of capital goods. We'll check up each of the situations one by one. The longest of all of these is the one related to registration, where the government will have to give input tax credit to the taxpayer. A taxpayer would register himself under GST in three situations. One, where the law forces him to, where he's liable to register. This force, that is the liability to register, depends on a threshold. We'll get to that in a bit. Second, he'll voluntarily go and register. He's below the threshold for registration, but he'll still go and register. This is because he would want to claim input tax credit. That's more beneficial for him than the complications of registered taxpayer. The third situation is where he's no longer a composite dealer. He becomes a normal dealer and hence he has to register. The first two situations involve a threshold. What is this threshold? It is based on aggregate turnover. We've already seen what aggregate turnover is in the second module. The law has separated aggregate turnover limit for Northeast and the rest of India, where the aggregate turnover for the rest of India except the Northeast is 19 lakhs or more. The taxpayer is liable to register, while in Northeast the limit is 9 lakhs. So if a taxpayer's aggregate turnover is 19 lakhs or more, or 9 lakhs or more respectively for rest of India and Northeast India, he is liable to get registered under GST. We know that being registered is one of the conditions for claiming input tax credit. Non-registered dealers will not get input tax credit claim. So once a taxpayer is registered, it is the duty of the government to give him credit for his input. So there's a special circumstance that arises here. He can claim input credit on raw materials, semi-finished goods and finished goods that he holds in stock, but there's a condition on timeline. This condition exists for all three situations under registration, so we'll check it out together after we've looked into the third situation, where the dealer is no longer a composite dealer, he's a normal dealer and he will have to register. We've seen in great detail what composition scheme is, that the composite dealer will have aggregate turnover less than 50 lakhs, or he's not engaged in certain sets of activities, then he can register as a composite dealer. He's broken one of these conditions and he's no longer a composite dealer. In such a situation, this dealer will have to register and he'll be eligible to claim input tax credit on raw materials, semi-finished goods and finished goods like in the case of other registrations. But there's one more thing he can claim input credit on: capital goods. Again, there's a condition for timeline. Let's check out what this condition is. For a person who's liable to register, who's above the threshold limit for registration, he is required to apply for registration within 30 days from the date he becomes liable to register. That is, within 30 days from when he crosses 19 lakhs or 9 lakhs of aggregate turnover. If he has applied within 30 days, then he can claim input tax credit of stock that is lying with him from the day immediately before he became liable to register. So suppose he became liable to register on 1st of October. He's applied on 15th of October. Then he can claim input tax credit for all of his stock from 30th September onwards. The second situation, voluntary registered, he can claim input tax credit from the day immediately before the date of registration. Simple. The stock just before the date of registration, he is eligible to claim input tax credit. For the composite dealer, this timeline is from the date he ceased to be a composite dealer. So those were the circumstances relating to registration. The second is where earlier exempted outward supply have now become taxable. So the government would have to give credit for inputs used for taxable supplies. Such a taxpayer would be eligible to claim input tax credit on raw material, semi-finished goods and finished goods which are relatable to such exempt supplies, and capital goods which is exclusively used for such exempt goods. There's a condition: input tax credit on supplies held in stock right before they became taxable. Only on those supplies he can claim credit. He cannot claim credit on invoices which are more than a year old. Even if those goods are still in stock, he cannot absolutely claim any credit on invoices more than 1 year old. And the third is that the credit on capital goods would be reduced by a percentage point which the government would prescribe from time to time. Coming to the next circumstance of transfer from one business to other. It is only when there's a sale, merger, demerger, amalgamation, change in constitution of a business would trigger this transfer. There's one condition though, that the contract of change in constitution, contract of sale, should have a specific provision for transfer of liability. That arrangement has to be made. Only then input tax credit balance in the books of the transferor can be transferred to the new business. Moving on to the next situation where the taxpayer will have to forfeit tax. He'll have to pay back the input tax credit claim to the government. It would just be opposite of what we've already seen. In the first situation where previously taxable goods have now become exempt, or that the taxpayer has opted for the composition scheme, then he'll have to pay back to the government input tax credit claimed for raw material, semi-finished goods, finished goods, relatable to such exempt supplies or just in the stock for a composite dealer, and capital goods which are exclusively used for such exempt goods. 3 points that you'll have to keep in mind for this situation: input tax credit on supplies which are held in stock right before these goods became exempt or right before the dealer converted to composition scheme. The input tax credit on those supplies will have to be paid back to the government. The credit on capital goods, as we've seen before, would be reduced by a percentage point which the government would prescribe from time to time. After the taxpayer has paid back this amount to the government, the balance of input tax credit in his electronic credit ledger would lapse. He will no longer be able to claim it against output tax liability. The last situation is related to capital goods, where the dealer has disposed of capital goods. Now the logic is somewhat in line with the principles of negative lists that we've discussed. If these capital goods are disposed of, remember the RIP goods, disposed of goods, that's the category we are talking about. they'll no longer be able to contribute to value addition, and input tax credit will have to be paid back. There's a formula which has to be used. Only so much amount will have to be paid back. The higher of input tax credit claimed minus a specified percentage point. This point again will be prescribed by the government, or the tax on the transaction value received on the sale or disposal of the goods. Higher of these two amounts would have to be paid back to the government. There's an exception if you're disposing of refractory bricks, molds and dies, jigs and fixtures supplied as scrap. Then the input tax credit that you'll have to pay back is just the transaction value. You need not check the higher of the two components, just pay back the transaction value. And so these were the 5 special circumstances under which transfer of input tax credit from taxpayer to government, vice versa from one taxpayer to another taxpayer would occur. Registration, exempt now taxable, change in constitution, taxable now exempt or composition scheme, and disposal of capital goods. So in this section, we've understood the 10 conditions for receiving input tax credit, and we've also seen the 5 special circumstances for transfer of input tax credit.